So we're asked a lot, why infrastructure now? So I'm going to give you the high-level case for infrastructure in the context of today's market and macro environment. So first, when you think about the several macro factors that influence infrastructure performance, we'd argue that they all point to a positive outlook for infrastructure today. So first, when you think about growth globally, a lot of question marks about growth, but certainly we believe that growth is slowing. Not necessarily forecasting a recession, but growth slowing, which is generally positive for asset classes that tend to be more defensive, like listed infrastructure. I think the second point really relates to central bank policy. And clearly in many developed markets around the world, notably the US, Europe, for example, we're seeing central bankers starting on their easing cycles, which again, for a capital intensive asset class like infrastructure tends to be a positive thing. And then lastly, inflation. As we know, many infrastructure businesses have pricing mechanisms that are linked to inflation. And while we have seen inflation come down tremendously from the peak seen a couple of years ago, we think inflation has the potential to be quite sticky relative to expectations. So, when we think about the fact that we are in an era of scarcity, when it relates to commodities relative to an era of abundance that we saw in prior cycles, when you had, I'd say, less environmental restrictions, fewer zoning restrictions, and frankly, a much lower cost of capital for commodity producers. It's a different world today. So we think between tightening commodity markets from a supply-demand perspective, as well as sort of just-in-time inventory approaches by retailers, which is going to mean more price action when demand increases. We think that inflation should remain higher than trend and likely to surprise to the upside. So when you think about infrastructure, again, it tends to outperform broader equities in periods of slowing economic growth or weaker growth than the market expects, falling interest rates, which is what we expect to see, at least from a central bank policy perspective, and higher than trend or higher than expected, I should say, inflation. So one, fundamental case for infrastructure relates to that macro outlook. The second point relates to valuations. So infrastructure historically has traded at a 10% premium to broader equities on a cash flow multiple basis. That's EV to EBITDA, enterprise value to, basically to cash flows. 10% premium, excuse me. Right now, infrastructure is trading at about a 10% discount to broader equities. We think that is exceptionally cheap in the context, again, of that macro environment that we believe that we are in and certainly moving towards at the end of this year and into next year. So we think the asset class is cheap in the context of that environment. And then lastly, some real interesting fundamental tailwinds. So there's themes that we've talked about for some time, like digital transformation of economies and the Internet of Things, and what that means for demand for data, which benefits certainly cell tower companies in our universe, as well as data centers. Another theme that we've talked about a bit is evolving supply chains, geopolitical tensions, worker strikes that are causing really a rewriting of supply routes around the world, changing logistics supply chains, which are benefiting a number of companies in the freight transportation space, like freight railways and marine ports. Of course, some of these plays can be a little bit more idiosyncratic. The last theme that we'll speak about, that's I'd say is a tailwind to the space today, relates to power demand. And we're coming off of a period of, take the US, for example, flat power demand for a decade, really longer than a decade. And for a number of reasons, we're seeing rising power demand growth, which is set to benefit, in our space specifically, utilities, nuclear power companies, as well as midstream energy companies, those that focus on natural gas pipelines, processing, and storage. A theme that we're really excited about today, and I mentioned it in the first point, relates to the increasing power demand that we're seeing in many markets around the world. Again, due to efficiency gains that we've seen on appliances and the like over the years, we've effectively seen flat power demand and actually decreasing power demand in several developed markets around the world over the last decade. Now, what's changed that's driving this much more positive outlook for power demand? And it's really three things. First, electrification trends, whether it's electrification of appliances, Internet of Things, much more power intensive appliances, but also electric vehicles, which are clearly driving increased power demand around the world. Second, it's precision manufacturing. So manufacturing around the world that is much more power intensive, given how precise the manufacturing is and the equipment that's used in the manufacturing process. Lastly, it's data center growth. And this is clearly the theme of the year as we look at all of the cloud providers and their demands for data over time and what that means in terms of both data center growth and then the power that's needed to fuel effectively those data centers. So again, just by context, if you look at the United States, for example, historically over the last 10 to 15 years, we've had zero electricity demand growth. We were already forecasting about 1 to 1.5% demand growth just due to electrification trends and also due to certainly other dynamics within that market. But now we are seeing, the fast rise in demand from data centers, which is taking our forecast to 2 to 2.5% a year through 2030. So pretty significant increase in data demand, which is going to have big implications for a number of companies within our universe. So specifically within our universe, it's electric utilities, it's companies that have access and exposure to nuclear generation, and then it's midstream energy companies. And specifically within midstream, it's those companies focused on transporting, storing, and processing natural gas, which is a fuel that we think is going to be a very important part of energy transition, but also an important part of the satisfying of all of this demand for power, not only in the US, but all over the globe. So again, the theme is data center demand. There are a lot of nuances to this theme, meaning, yes, we think companies can benefit within our universe. So utilities, for example, utilities make more money when they're able to invest more because they earn an attractive rate of return on that investment. But one has to also be wary of price shock, meaning the more you invest, the higher price you have to charge your customers to recoup that investment in terms of allowed returns. And ultimately, companies have to manage the rate implications of all of this new investment. So for us, it's about finding the companies that are in attractive jurisdictions that have rate mechanisms that allow them to invest and grow their earnings per share. It's with companies who are owners of nuclear power plants, which are very cheap and reliable electricity that in some cases can sell directly to some of these data center owners and operators at very attractive power prices over the long term. So there are a number of different ways in which we can play this. And lastly, I guess, midstream energy, again, there are companies who are the leading players in, again, midstream energy, owning and operating pipelines in North America that will fuel the gas-fired power plants that are helping to satisfy this demand growth. So, billions and billions, tens of billions of dollars of investment that are needed, not only in power plants to satisfy this demand growth, but also the transmission wires to connect new data centers to these power plants. Clearly, a big topic of discussion right now is the election in the United States and implications not only for the broader market, but also for infrastructure. So, it's going to be a tight election. It seems very clear between Trump and Harris. I think the reality is it's going to be very tight, and we're likely to have a divided Congress, meaning implications are going to be minimal in terms of massive policy shifts. But on the margin, I think there are two places within infrastructure you have to keep a close eye on. So first, it's energy policy. And clearly our current administration has been very favorable as it relates to renewable energy. and the development of renewable energy, and it's a lot of tax credits for renewable energy development, ownership, and operation. I think the vast majority of those tax credits will stand, solar and wind being the most important within our universe. And this is a lot of this through the Inflation Reduction Act, the IRA. So I think most of that will stand. It'll be very difficult to repeal IRA in full. In fact, a lot of Republican states have been the biggest beneficiaries of IRA policy, in fact, through renewable spending. So I don't think we're going to see big changes with a new administration, or at least with a Republican administration, to the extent that Trump wins. I think at the same time, there's an increasing acceptance of natural gas as a transition fuel, as I've mentioned already. So I don't think we'll see a big change as it relates to policy for natural gas specifically, which is important for our universe of companies. I think the second point is on taxes. So we have some diverging tax policies, clearly with Trump looking for lower corporate taxes and Harris looking for higher corporate taxes. Again, I think any major corporate tax change would be very difficult to pass with a divided Congress. With that said, we know which businesses within infrastructure are the largest cash tax payers. So, for example, freight railways have historically been the largest cash tax payers. So to the extent that we see a change in corporate tax policy one way or another, we could see the most significant impact on those businesses, certainly relative to other things within infrastructure. So takeaway is, we think the election is going to be fairly close. We think we're likely to see some sort of a divided government, which likely means little major sort of policy implications, or few major policy implications for listed infrastructure companies.